Directors' loan accounts are one of the biggest tax traps for UK directors, and if you run a company and you might have dipped into the bank account, paid personal bills on the company card, borrowed a bit and told yourself you'd sort it out later, then this video could save you literally tens of thousands of pounds. Now, most directors don't wake up one day planning on abusing a director's loan account. It usually starts very small. A little borrow here, a personal expense paid by mistake, a short-term cash flow issue. But HMRC don't care how it started. They care how it ends. And in 2026, HMRC are laser focused on directors' loan accounts. And I see it every single day at Director First. Directors come to us stressed out, they're exhausted, they are dealing with HMRC pressure. And then we look into it and we see they've incurred a director's loan account and they didn't even realise it was a problem. Now suddenly the company owes more tax to HMRC, okay? The director owes the company money, and if he ends up in, or she ends up in an insolvency process, the director is going to be asked to pay it all back. So listen, this is what you're going to learn in this video. In this video I'm going to break down in plain English what a director's loan account actually is, when it becomes dangerous, how Section 455 tax works, what happens if the loan is written off, what changes in insolvency, and why HMRC and insolvency practitioners are coming after these like never before. Okay, so what is a director's loan account really? So let's strip away the jargon so everyone understands. A director's loan account is simply a record of money moving between you and your company. That's it, okay? It's not your salary. It's like money you've put in, money you've taken out, right? Now, there are common reasons why people have a director's loan account, okay? Certainly an overdrawn one. They're taking cash from the company bank account. You're paying personal bills on the company card. You are using company funds between dividends. So basically, you might be a director who gets, I don't know, £4 grand a month, £1,000 a month of salary, and in your head, you're taking your money, your other £3 as a dividend. Well, it's not a dividend yet. It's only a dividend at the end of the year when your accountant does its accounts and he declares a dividend out of profits. At this moment, it goes on a director's loan, okay? Also, if you're putting money into your company, that's on your director's loan account, right? So if the company owes you, the director's loan account's in credit. If you owe the company, you have an overdrawn director's loan account. And this is why HMRC cares so much. Because DLAs are the easiest way for directors to take out money out of a company without paying the right tax. Sometimes you do it accidentally. Maybe sometimes you know what you're doing. And now HMRC, they don't need to prove intent. They're just looking at the numbers. You can't hide from these. Now, if you are a small limited company or a close company, you are now in HMRC's crosshairs. And this is where a lot of directors I see are falling into a trap. So if you run a UK close company, which most of you watching this video are, you sort of own and manage businesses, there are certain tax rules that apply to you. So a close company, for those that didn't know, is basically a private company. It's controlled by 5 or fewer shareholders, or it's controlled by directors. And what it means is HMRC assumes you control the money. And when you control the money, HMRC assumes responsibility sits with you. Now, I'm going to talk about something called Section 455, right? And it's a tax most of you guys and girls out there don't see coming. It's a biggie. Now, what is Section 455 tax? If your director's loan account is overdrawn and it's not repaid within 9 months and 1 day after your year end, HMRC charges the company an extra tax bill. They don't charge it you personally, they charge the company, and it's called S455 tax. How much is it, I hear you say? So currently it's 33.75% of the outstanding loan. So if you owe the company 40 grand, HMRC wants another 13.5 grand from your company on top of corporation tax, on top of everything else. And this is the bit that directors miss. Yes, listen, people tell me, yeah, well, I can get that money back. yet the tax is refundable when the loan is repaid. But that 13.5 grand is cash gone in the meantime, straight out your cash flow. HMRC will keep any interest. And if the company goes insolvent through liquidation or administration, that refund probably won't ever come back. And this is why directors' loan accounts can blow up in businesses into insolvency. Now, this is something that a lot of you don't know. I'm going to start to talk about the personal tax implications. This is where a director's loan account is going to hit you, okay? Now, you've got beneficial loan charges. If your loan goes over 10 grand and you're not paying interest at HMRC's official rate, the HMRC says, well, you've received a benefit. That means benefit in kind, P11D reporting, Class 1A national insurance for the company, and HMRC are checking this far more than directors realise in 2026. Now, you might be saying, well, what happens if the loan's written off? This is where it can get really ugly. If a director's loan is written off, it's released, or it's cleared through an insolvency process, okay, the HMRC can tax it as a dividend at dividend tax rates. So, the director could pay more income tax. And this is a problem, because this director's loan account is going to cause you a problem after the business is dead. Now, I want to sort of talk about anti-avoidance rules, because HMRC aren't stupid. Some directors just think they can play the game like they've invented this. And HMRC have seen it all. There's like a 30-day rule. So if you repay that, let's say you owe 40 grand and you pay 40 grand into the company to clear off your director's loan, and then you borrow it again within 30 days, HMR treats it as never been repaid. It's called bed and breakfasting, okay? Now, even if it's outside 30 days, if there's an understanding that money would go out again, HMRC can still block the relief, okay? And we are seeing this more and more in 2026 because they can just see more things. Now, this is a bit that is very important from my point of view. Remember, I'm an insolvency guy, and directors' loan accounts in insolvency are starting to cause people problems after the insolvency. Now, if your company goes into liquidation or administration, right, an overdrawn director's loan account is an asset of the company, and the liquidator is legally required to pursue it, okay? And you'll probably say, yeah, but I meant it to be salary, but it should have been a dividend, and I didn't know. Like, insolvency practitioners don't care. If it's recorded as a loan, it's a loan. If it's a dividend that you've taken and your company can't afford to pay that dividend, it's going to be reclassified as an illegal dividend and go on your director's loan account. So remember, an insolvency practitioner, their job is to try and get this money back from you. You know my problem with this, right? There are good firms out there like us that will tell you about it pre-appointment and say, listen, you've got a director's loan account here. I can tell within 20 seconds of looking at your accounts, okay? And I will try and help you manage that process, help you understand what your exposure is, and hopefully negotiate a settlement, right? Some firms don't mention it. They don't mention it. Oh, we'll deal with it down the line. You need to get sight of this before you make any decisions, I believe, right? So when you go through an insolvency process, like admin or liquidation, the insolvency practitioner is going to ask you to pay the director's loan account back. Now, you've probably not got the money to pay it back. Otherwise, you wouldn't be seeking insolvency advice, right? So what's going to happen is the insolvency practitioner is going to assess your means, okay? They're going to see, have you got property? If you're in a £1 million house with no mortgage, this is a big problem, because in theory, the insolvency practitioner could make you bankrupt and get all the money back and get their costs, right? Equally, if you're in rented accommodation without a pot so you know what in or a window to throw it out, there's a good chance the insolvency practitioner will just write it off because it's not worth pursuing you, okay? But here's the issue that lots of people don't realise. I had a director ask me this the other day. HMRC could still tax any write-off. And this is the bit where directors are really shocked how personable it becomes. So I want to sort of give you some guidance on some recent cases, recent tribunal cases. And it basically says paperwork really matters, language matters, and intent doesn't override structure. If a loan isn't formally released, HMRC may not tax it yet. If it is released, expect a tax bill. So this is how you should handle directors' loan accounts. Here is a framework that I help people with on a daily basis. First of all, track the bloody thing monthly. And you can track it through accounting software and having someone put the information into your accounting software. Like everyone needs a good bookkeeper. Don't let directors' loan accounts get out of control. Clear a loan within 9 months of your year end. Only pay dividends from genuine reserves. Charge interest properly if it's required. Never assume insolvency makes it disappear. The insolvency practitioner might not pursue you for it, but that's not to say HMRC hasn't said, well, it's income, you've had a benefit for it, we're therefore taxing you. And get advice early, not when HMRC are already involved. So, I want to wrap up. Directors' loan accounts are not harmless. They are one of the fastest ways to end up paying extra tax, create personal liability in an insolvency, and turn a business failure into a personal problem. Most directors don't get caught because they're dishonest. They got caught out because they don't understand the rules. Now, if you're a UK director with an overdrawn loan account, or you're worried HMRC are going to come knocking, speak to us today. We'll help you understand your director's loan account properly. We'll explain your exposure. We'll help you deal with HMRC. Now, if you found this video helpful and you want to know more about how you deal with an overdrawn director's loan account in insolvency, go and watch that video. It's going to tell you exactly what your director's loan account is. It's going to help you understand where your director's loan account is. And more importantly, what you can do if you are being pursued by an insolvency practitioner. Thanks for your time, Chris Worden. Bye-bye.